Good afternoon, lady and gent. How are you all?
Good afternoon, sir. Fine.
Good, good, good. Okay, so we're going to get started. The other two will probably join us momentarily. Okay, so tonight we're going to be doing some review. I had sent an email this morning asking you to have certain items on hand that we'll be going through tonight. If I tend to be going a bit fast, you can slow me down for any area that you may not understand or need some further clarification on. But just with everything tonight, everything tonight we have covered, so in one form or the other. So a lot of time is going to be spent on the case study type question. And we're going to be looking at three of them, including our star case, Martin and Sherry rule. Okay. So again, tonight's class, we'll be looking at Martin and Sherry rule case study question. We'll be looking at James and Paula Brown, a portion of which was in homework number 3, and also the other portion was in class assignment number 3. We're going to review homework number 6. We'll also review the mock final exam, which is an ungraded assignment. And in that, there is Hezekiah and Lottie Balfour case study. So we'll be looking at that. That was in the mock final. That was also, we didn't actually get to do it in class, but as an assignment, but we did cover it. Hezekiah and Lottie Balfour. So we were looking at that again. So we were looking at the three case studies that we looked at some point during the class. Then I'll go through some exam tips and other information related to the final exam, most of which you have already received. So let's start with Martin and Sherry rule. So if you could take out those scripts, particularly the ones that you've completed, with the completed stuff, we'll, like I said, we'll go through them fairly quickly. So we'll be doing these things: complete the net weight statement, complete the TDSR spreadsheet, answer the question: what is the current mortgage LPV LTV ratio? What is the current equity? Would you grant the loan? Supporting your answer, and if there are any areas of concern, areas, I should say. Okay, so we have Martin and Sherry rule, the case study. That's the narrative there. Okay. Also, we have an extract from the real estate appraisal, and in fact, we went through the appraisal in our exercise, our tick sheet. So we went through the full appraisal, but this is the excerpt from that appraisal that that relates directly to this particular case study. The other item that you would have would be the printout of the auto loan, the consumer loan, which is an auto loan. Also the mortgage loan printout statement. And so let's look at the first item. Doing the net worth. Now this net worth statement is pretty short because we're not given much information. We weren't given any information on their cash, nor any stocks or bonds, any accounts receivables, any cash surrender values, any life insurances. The first item we had was a real estate, right? And where in this do we get the real estate value? This is the asset side.
Real estate value, you get that from the appraisal or the actual bank statement or printout?
Yes. Okay. So and in this instance, we've used the mortgage loan statement. That amount was verified when we looked at the appraisal. The current appraisal showed at $275,000. Okay, so we put $275,000 in there. Okay. What else do we have as an asset for them? Refer to your to page 101, the narrative.
Sorry about that, sir. I just stepped away. What was the request?
Yeah, I was saying, what is the other, and any other assets? We got the real estate. Are there any other assets from the narrative that we are? Car, okay. And what is the current value on the car?
24,300.
24. You faded away. 24.
300.
24,300. Yes. Okay. So 24,300 again. We got that from the narrative, or the bank statement, right? So current collateral security value 24,300. Okay. Are there any other assets that we are given?
No, that's all.
No, that's it. Okay. So we can add those two, and we get 299,300 as a total assets. Okay. So the next we look at is excuse me, we go to the liability side. They own a house, so they're not paying rent. The next item is credit cards. Do they have any credit cards?
We have 2 credit cards, sir. One with
Okay,
RB.
and okay,
One with a
okay.
balance of 2,395 and the other with a outstanding balance of $50.
Right. Okay. So we add those two together, right? We add those two together. That's the section in blue, and we get $2,445.
Then they two credit cards. Mr. Nottage, we can't hear you, sir.
Oh, I'm sorry. I'm hoping okay, so I said I'm hoping the internet stabilizes. So we finished with the credit cards. We did the total of the two outstanding balances. So that's 2,445. So I was asking, do they have a consumer loan?
Yes, sir.
There's the vehicle.
Okay, so they have the vehicle or the car loan, consumer loan, and what is the amount owing on that, or the balance that we put in there?
$16,162.
Okay, correct, 16,162, and we get that from the consumer loan statement. Okay. Any other liabilities?
Yeah, the mortgage.
Okay, and what is the outstanding balance on that?
76,935.
Okay, 76,935, correct. And again, we get that from the left-hand top section of the mortgage statement, 76,935. Are there any other are there any other liabilities that we're aware of, what we've been told about?
I don't think so, sir.
No, they don't have any more liabilities.
Okay. All right. So we add those three together, we get 95,542. So we put that we put that under the asset total less total liabilities. So we just throw it over there. And then we get our net worth of, we take the 95,542 away from the 299,300, and we get a net worth of 203,758. Is that net worth positive or negative?
Positive, sir.
That's positive. Okay, correct. All right. So are there any questions on that?
No, sir.
No. Okay, good. So we've completed the net worth statement. We're going to move on to completing the TDSR spreadsheet. Okay. So we start with Martin Roll. His salary, $450 a week. So we have the first column to fill out the monthly amount, the second column, the percentage used, and the third column, the adjusted amount. So what amount do we get for the salary, for the monthly amount to fill in the first column?
1,950.
1,950. And what percentage do we use of that?
100%.
And that goes also in the adjusted amount column, right?
Yes, sir.
Okay, great stuff. Okay, what about gratuity?
1,300.
Okay, and how much of that do we
1,300.
use?
50%.
Yes, correct. Yes, 50%, okay. And the adjusted amount?
It'll be 650.
Will therefore be 650. Okay, great. Okay, so let's look at Sherry Roll's salary, 2,200 per month. What goes in the monthly column, the percentage used, and the adjusted amount? Give me those three figures.
It'll be the same 2,200 at
Okay.
100%, and the adjusted amount will be the same as the monthly amount.
Okay, great. Now, what about the bonus? How do we deal with the bonus?
The bonus would be $750 a month,
And we use how much percentage of that?
50%, and that'll be $375 adjusted.
375.
Mhm.
Right, so that'll be 375 adjusted, yes. Okay, and then we just add those up, and that'll give us our total of $5,175. Okay, great stuff. Okay. Okay, so we now move on to the expenses because that's our total income. We look at expenses. The first one is a mortgage at FinCo, $975 per month, which goes in the monthly amount and which goes in the adjusted amount.
$975 goes in both.
Goes in both, yes. And what about the car loan amount?
530 would transfer over as well, both.
Both, yes, okay. The proposed education loan,
The $340 in both.
okay, great stuff. All right, now we move on to the credit cards as part of the monthly expenses. The RBC Visa,
So it'll be 5% of the 4,000 limit, which is 200.
5% of the limit, yes, which is?
$200.
Okay, so we will put that in both columns, monthly amount and the adjusted amount. And what about the CIB card?
160.
And that goes in both as well. Okay,
Mhm.
great. So we finish the expenses, we add up the expenses, and we get 2,205. Okay. How do we calculate the TDSR?
So it'll be the expenses divided by the total
That's-
income
So,
multiplied
Okay.
by 100.
And you get what figure?
I got 42.61%.
Okay, so you could put 42.6, 42.6, whatever it is, or 43, rounded up to 43% is up to you. Okay, either of those are acceptable. All right. So so we've done the spreadsheet. Let's look at the current LPV. Okay, so the current LPV, here's the LPV or LPC calculation. The loan amount divided by the asset cost or value multiplied by 100 gives us the LPC or LPV, which is a percentage. Okay. So what is our numerator?
That'll be the principal, the 76,935.
76,935, yes, which is the outstanding balance on the mortgage. We get that from the mortgage loan statement, and it's also on the liabilities side of our net worth statement. But our source document, our initial source document, or our main primary source document would be the mortgage loan statement. Okay, so that's our numerator, 76,935. What is our denominator?
275,000.
275,000, which is the value. So we get that from the mortgage loan statement again. That bottom right-hand side, 275,000, or we could get it from the asset side of our net worth. So it's 76,935 divided by 275 times 100 gives us what?
28%.
28%, yes, okay. Or for those who want to use the decimal points, 27.98 or 28%. Okay. And like I said, you can also get those figures from the net worth statement. Okay, the value on the asset side and the balance on the mortgage on the liability side. Okay, so we've completed the LPV. Let's look at equity. Okay. Okay. So equity is any dollar value or amount you own or person owns in real estate property, less any loan or other encumbrance owing against it. Okay, and here's the equation. It is the current value less any current encumbrance or encumbrances, which will give us our current equity. So what is our current current value?
275,000.
275,000. Okay, and we get that from the bottom right-hand side of the statement. So our current value is 275,000. Okay. What is the encumbrance that we are aware of?
The balance, that's the 935.
The 76, yes. Okay. We get that from the left-hand side top of the mortgage statement. Okay, so that's 76,935. Okay. And so when we subtract that, we get 198,065. Okay, so equity, equity is what the owner or the person who's borrowing, what they own in the property is a dollar value, whereas LPC or LPV is a percentage. It says tells you how much they own, how much they owe as a percentage of of the overall property value, current value. So LPC is a ratio, equity is a dollar amount. Okay, and again on this we get those figures from the mortgage loan statement, and or they are in our net worth statement. Okay, again, your mortgage loan statement is your primary source document. All right, so we've covered ABCD. Current equity is the last. Based on what we have done so far and our discussion in class, would you grant a loan to Martin and Sherry Roll?
Yeah.
Yes. Okay. So we said yes, we would grant a loan to the Rolls. All right. And then, excuse me. So it's one thing to say that you would grant a loan or not grant the loan. You have to support your answer, whether it's a yes or no. If it's a yes, why you would grant it. If it's no, why you would decline it.
So they have a positive network to start with.
Pardon me?
I was saying they have a positive net worth. We could start with that.
Okay, you're breaking up.
Hello?
You said they.
I said that they have a positive
Yes.
net worth.
Positive net worth, yes. Okay.
We could say that they both have stable jobs or stable income right now.
Stable, yes, stable jobs, yes, okay.
Their credit history seemed okay from the loan statements and stuff.
Yes, okay, good.
The equity is good, so then we could say the collateral would be good for them.
Okay, excellent, good,
What else? They have the ability to pay the loan. Obviously, they have jobs, stable jobs.
Okay, alrighty, okay. And when you're looking at ability, what is one of the measurements you're looking at? The debt service ratio, right?
So that would be like, okay, they not only can they pay the loan, but they could accommodate other things out of their pay as well.
Yes. Okay. So so here's what I'm going back from the list that you was given, and also what we have stated in class. They may not be in the order in which you gave them, but they're pretty much follow, right? So they both have job stability and tenure. They still have a good number of income earning years before normal retirement. They have excellent credit history. They have a positive and substantial net worth. They have good ability to pay the loan with a little bit of room for additional debt. The collateral is excellent. You talked about the equity, yes. And if we looked at the appraisal, you saw that the subdivision was upper middle class. The condition of the house was excellent because they had recently done some repairs. Okay, so all that comes into play. One of the things to remember when you're doing loan applications is to hit on your main points and cover your main 3 points, which are your character, your capacity, and your collateral. That is, if you're using credit C's, and if you're using Campari, it'll be your character, your ability, and your insurance. Okay, so those 3 are the same. The counterparts of Campari and credit C, they're the same. So if you keep those in your mind, character, capacity, collateral, you shouldn't go wrong to make sure you get at least one of each of those points as far as practicable. Okay. These ones, again, I've color coded, we've been through this before. 1 to 4 deals with character, 5 deals with ability or capacity, and 6 deals with collateral or insurance. Okay, so again, we've done this next exercise using the 3 key factors, using either Campari or, excuse me, or Credit C's method for assessing credit loans. Briefly outline your reasons for approving or declining the loan application. So we use some of those same points, right? Use at least one of those points. Well, for 2 of them, we only have 1 point. But you either use the Campari method, which will be character, ability, and insurance, or you'll use the Credit C's character, capacity, and collateral. And so if you line them up, character, you have 4 points, ability, you have 1 point, collateral, you have 1 point. And so you can choose to put one of those in, one of those 4 in character, then that one there in ability, got ability to pay the loan, and the collateral is excellent, equity, subdivision, blah, 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 for insurance, okay? And it'll be the same thing if you choose to use the Credit C's method, character, capacity, collateral. Okay, any questions on that?
I'm good, sir.
Okay. Alrighty, so we've done A, B, C, D, and E. So the last one is any area of concern or areas of concern. Any area or areas of concern. Are there any areas of concern that you remember from our dealing with this?
Only thing I remember was that the total DSR was like really close to the maximum, which is 45%.
Right, because I think it was like 42 or 43% thereabouts.
Yeah.
And TDSR is 45. Let me just say about the TDSR. In one of the previous classes, I indicated that the central bank, and I think I sent the article or the link to the article, but the central bank has eased up on the TDSR, and so they're allowing banks to go up to 50%. Okay, for the purposes of this course, seeing that that's a new development, we will still stick with the 45%. Okay, so so that we don't have any confusion, we'll use 45%. When you get in your workplace, going forward, you'll be using 50%. That is, if your financial institution is willing to go on the upper limit, because it's pretty much left with the financial institutions whether or not they want to move from the 45 to the 50%. I suspect, because of competition and trying to get loans on the books, most financial institutions, if not all, will probably move towards the 50% as their standard. Okay, but again, for this class, for the final exam, we'll be looking at a maximum of 45%. Okay, so again, like you said, the TDSR is close to the maximum, and the concern about that is that the proposed loan only covers the first year of college, and we did a little discussion about how they will finance the remaining 3 years, assuming a normal 4-year program. And we talked about some things. Maybe there was a scholarship in the making, and they had to take care of the first year until the scholarship clicks in, and some other things we looked at discussing. But that would be a question that you would want to address with the rules. Okay, your areas of concern. Okay. The second one we looked at was, is this an only dependent child? Is there another child who will soon be college bound or college age? Again, how will they finance? Okay, so a lot of that information, again, when we are taking our loan applications, there's a section that talks about dependents. and it asks how many dependents do you have, and that's legal dependents. So if they're children who are of who are minors, or if they are college and they're still the responsibility of the people who are borrowing, or it could be a parent or both parents that the borrower, they're dependent on the borrower, they live with the borrower. So the dependents could be children, or the dependents can be, a parent, okay? Or it could be a sibling who may be physically challenged, right? Who's living with them, maybe someone with Down syndrome, whatever it is. And that's a dependent sibling who's living with them. So you'll get that information as you're completing the loan application when they talk about how many dependents. So that's how you will answer that question. The second question is this an only Nope.
Okay, you again, Mr. Nodded.
Yeah, I saw a little note where I said it was unstable. I was asking if there were any questions.
No, sir.
Those 6 segments for Martin Sherry Rule. So let's look at James and Paula Brown, another one. Okay. This was a home free. A portion was done home with. So we looked at the net worth and the TDSR. And we went through some of the other areas in class. So again, let's look at those. Or whatever you call it. Those are some items that were inserted in there further to what is in homework number 3, in order to help us to complete this all these questions. So that is the write-up for James and Brown. They need to borrow $30,000 from the bank. The residence is located in Blue Hill Heights. The range of properties 200 to 500,000. We have what the current balances are. So the current balance on the mortgage is $68,975. The current value of the very first sentence value is 210. Then it tells us some of the other. They have 2 vehicles, one with a loan. The value of both vehicles, it tells us that. It tells us about their payment history. Mr. and Mrs. Brown never missed a mortgage payment, and all other debts have also received timely payments. Tells us their 2 credit cards, their limits on their balances. It gives us their cash holdings, whether they're savings accounts, term deposits, and it tells us their weekly earnings. Okay, so let's move forward with this. Okay, so let's look at their net worth. Let's complete the net worth statement. Okay. So what is the first item on this that we need to complete?
Cash.
Cash. Okay. So the blue writing, the Browns have 1,700 in savings and 1,260 on a monthly term deposit. That gives us a total of what?
$14,340.
14,340, yes. Okay. So, okay. So what is the next, what is the next asset?
Would that be the real estate, sir?
Real estate? Okay, and what is the value on that, the current value on that?
That would be 210,000.
210,000, yes, okay. Uh-huh, okay. And then what any other assets?
They have some vehicles totaling, both vehicles combined about 46,000, sorry, sir.
Okay, so the value of both vehicles is 46,000 combined. Okay, so we plumb that in there. Okay. Any other assets we're told about?
No.
No, sir.
Okay, so we add those. We get 270,340. So now we turn our attention to the liabilities. So what is the first liability that they have? They don't pay rent. So
The credit cards.
credit cards, okay. So it tells us here in blue, there are two credit cards, one at Bob, and the other one at CB, gives us their limits and their balances. So what amount goes in that column?
$850, sir.
$850.
850, okay. Do they have consumer loan or loans?
Yes.
Okay, so it tells us that they have a loan over one of the two vehicles, and that the loan has a balance of 12,525. Okay, so we put that in there, right?
Yes,
Yes,
The
sir.
sir.
liability side. Okay. What else do we have there? They have a mortgage.
Yes, sir. They have a mortgage value of a loan outstanding of $68,975, sir.
Okay, so we plunk that in there. Any other liabilities?
No, sir.
Okay, so we add those three items. We get 82,350. We carry that over to where it says less total liabilities. We subtract that 82,350 from the 270,340, and we get 187,990. Is this net worth positive or negative?
Positive, sir.
Okay, so they too, like the rules, have a positive net worth. Very good. Okay. So we completed net worth statement, but let's move on to the debt service total TDSR spreadsheet. Okay. So what is the okay, so we begin by looking at James's income. He makes $750 a week. How do we deal with that in terms of monthly payment, percent used, and adjustment amount?
750 times 52 weeks divided by 12 gives you 3250.
Okay,
month.
and how much of that do we use?
100.
100%, and then an adjusted amount?
3250.
The 3250, yes. Okay, good. How do we deal with this bonus?
6,000 divided by 12 is 500.
Say what? Oh yeah, okay, yes, okay. And the percentage?
And then divided by,
It'll be
we'll use
50%.
50%.
Yeah.
Right, or divided by 2, yes, okay. So we
Yeah.
get 250. Okay, very good. Now let's look at Paula Brown's salary. How do we deal with that for those three columns?
5,200.
Okay,
We use 100%. 5,200.
okay. And then we add them up, the three of them, they'll come to $8,700. Okay, so now we move to expenses. How do we deal with expenses? The mortgage,
1140 in the monthly amount and the adjusted amount column.
okay, so 1140 in both columns. Okay, great.
348, same thing.
348 in both columns. Okay, great. Okay. The car loan.
725.
Okay, 725 in both columns. Okay. The credit cards,
5% of the $5,000. 250.
250 in both columns. Yes. Okay. And the CB Visa,
$100, sir.
sorry, 100. Yes, in both columns.
$100.
In both columns, right? Okay. So we add the 5 of those items together, and we get 2,563. What do we get as TDSR?
29.46, sir.
29.46 or 29.5, yes. Okay, now some of you might round it up to 30%. I prefer to personally to round it up to the highest decimal, but either one of those three would work. Okay, 29.46, 29.5, or 30%. Okay. So we've completed net worth and TDSR. Let's look at LPV for the Browns. Again, here is our equation. So what is our numerator or our loan amount?
$210,000.
Sorry.
Oh, sorry, no, I was looking at the mortgage value. Sorry.
Okay.
68,975,000. Yeah,
68,975.
68,975.
Okay, and our denominator would be what?
The 10,000.
The 210,000. Okay, and again, those figures are in our narrative. For James and Paula Brown, we weren't given bank statements, but we were given a narrative. Okay, so 210 would be the denominator, 68,975 would be the numerator. Okay, and those figures are also in our net worth statement. The 210, the value on the asset side, and the loan balance, on the mortgage balance, I should say, 68,975 on the liability side. Okay, and so that is our equation there. Okay, so 68,975 divided by 210 gives us an LPC of 32.85 or 32.9 or 33%. Okay, any one of those three would do. Okay, so we've looked at LPV. Let's look at equity. Okay, there's our equity equation. Okay, so what is the current value?
210,000.
210,000. So again, we get that from the statement. Okay, so 210,000. What is the encumbrance?
68,975.
68,975. That's the only encumbrance that we are aware of. Yes. So we subtract that, and we get our equity, our current equity figure of 141,025. Okay. So again, we get those figures from the narrative, which are also in our net worth statement. Okay. All right. So we've completed that. Let's answer question E. Would you grant the loan to James and Paula Brown?
Yeah.
You're a bit muffled. I didn't get that answer.
Yes. Yeah.
Yes. Okay. So we agree. Yes. Okay. So what are some, if we're looking at some support for our answer, starting with character rather. Okay, so the Browns pay the debts well. We're told that in the write-up. The Browns pay the debts very well. This is evidence of good character, which is essential when considering granting the loan. What about capacity? How was the TDSR?
They still have room to have any additional debts or any additional loans
Yeah, because the TDSR,
because right is that 30
yes. Okay, so just under
something.
30%.
Right.
Excellent, very good. Okay, what about collateral or insurance? Remember that the LPV was what, around about 30, just under 33%, right?
Yeah.
Okay. So what does that tell us? And the
Collateral
equity,
is excellent.
okay, and their equity. If you look back at their equity, they had a pretty good amount of equity. I think
Yeah.
140 some thousand thereabouts.
Yeah.
Okay, so the equity amount was good, and the loan as a percentage of the value is fairly low at just under 33%. Okay, and then when we looked at the value ranges of properties, this property is valued 210,000, and the upper range they say in excess of $500,000, right? So we got three things all wrapped up into one in here. They have very healthy equity. That's because they only owe 68,000 against $210,000 value. It's located where residences are valued in excess of half a million, and then the LPV is excellent at just under 33%. Okay, so that's using the credit series. If you're using Campari, basically you'll be saying the same thing, but just your headings will be different. So you would use character, ability, and insurance instead. Okay. So any questions on that?
Mr. Nottage,
Yes.
when would it be considered, the net would be considered negative? Because I know all
Negative?
of
When,
the scenarios that we've done were positive.
right. And for the most part, you'll probably have most of your clients with positive net worth. But then you'll come across those who are negative. That's where
For the
their liabilities,
more than the
where the liabilities are greater than their assets.
More than the assets. Okay.
Yeah. Okay. And you'll find that mainly people who may not have good savings or investment habits, and do not have any real estate. So, for example, the people who are chronic borrowers who come for consumer loans, you'll find that they have a very low net worth or negative net worth.
Okay.
Okay. Okay, so we've looked at those 6 areas for James and Paula Brown. Let's now look at homework. Homework number 6. Okay, so homework number 6. Let's see, what did I do here? Okay, homework number 6. Right, let me get my notes. Okay. So what I'm going to do is I'm going to go through the questions. Let where one or more persons may have gotten incorrect answers. I'm not going to go through all of them. So let's look at question 1. Okay. Question 1. LTV, loan to value ratio, expresses the dollar value amount you own in a piece of real estate. Okay, that is false. Okay, remember, when you're talking about ratios, you're normally looking at percentages. It says expresses the dollar value. Okay, we'll talk a little bit later about that in the exam tips. But again, there's some phrases and stuff that look at what is being said, okay, and what is being asked. So loan to value ratio expresses the dollar value amount you own in a piece of real estate. That should be false. Okay. Question number 4. Invoices, financial statements, business plans, and other supporting documents or documentation items that are placed in the credit file. Okay. So not the security file. The security file is what is locked away in your vault under dual control. So 4 should be false. 8 was another question. A chattel mortgage is a legal document used to take lien on property other than real estate. Okay. Such as vehicles, furniture, equipment as collateral security for a loan is usually used for the personal or individual borrower. That should be true. 8 is true. Okay. And 9, delinquency must be called in the first 5 days. Remember our
Mr. Norton,
yes, sir.
I'm sorry, sir, for interrupting. You said number 8 is true.
Yeah, that's what he said.
Yes, 8 is true. A chattel mortgage is a legal document used to take a lien on property other than real estate. Assets such as vehicles, furniture, equipment. So you take a chattel mortgage over cars, over furniture, over equipment.
Thank you, sir.
Okay. So the operative words is on property other than real estate. Okay. And property is not used in the sense of real estate there. Okay. Maybe it should have said assets would have been a better wording, but on property other than real estate. Okay. So again, this is where you have to read carefully what the question is saying. Okay. Other than real estate. Okay. Number 9. Delinquency must be called in the first 5 days. Remember our timelines for action. And we said if you wait too much longer after 5 days, it's difficult to catch that first payment, because now you're going into the second payment being past due. Okay, or being coming due. Okay, so 9 is false. Okay, number 10, and I think where some of you may have gone wrong is, and I think this morning I know this morning I referred some of you to my August 18th email, in which we also covered in class of the updates, and I provided the updated information with regards to outlawry dates on mortgages. So the email, that section, I can't remember the pages, the page numbers, but I think it might have been like 52 or something like that, or 59. Anyway, there were several chapters that I did the updated information on, with the exception of the VAT, the page on VAT, okay, for real estate transactions. So please read that. Judgments obtained in a magistrate court against a loan client, they cannot be appealed to the court to the Court of Appeal. In the magistrate's court, you cannot go to the Court of Appeal. There's only for indictable offenses.
Yeah.
And indictable offenses are like murder, rape, armed robbery, that kind of thing. Okay, only those can be appealed to the Court of Appeal. Okay, so money matters or pecuniary matters cannot be appealed to the Court of Appeal. Okay. So that was, I think that was it for section 1. Section 2, I have
Mr.
Yeah.
Nottage,
Yes, ma'am.
number 11.
Number 11, yes.
Can you go over the judgments for me, please?
Okay, so it says a judgment is issued by the courts against the defendant for the value of the matter heard by the court. If the judgment is not settled, this could create difficulties for the defendant in obtaining a mortgage or even purchasing or selling real estate. So for the life of that judgment, if a judgment is obtained by a person, that is recorded in the registry of records. And so whenever someone goes to buy or sell real estate, and a title search is done on them, it'll show up that they have a judgment against them. And they cannot buy a piece of property or sell a piece of property they own until they settle the judgment.
Okay.
Okay?
Okay.
All right. So moving on to section 2, I have an apology for at least 2 of you, because that was not a very good worded question, and so it created some confusion. How that question should have been written was loan to asset value ratio, or LAR, expresses. Okay, so I apologize for that. Those who that was marked wrong, I've gone back and I've given you credit because that was not your fault, that was my fault. Okay, so those who answered E or A, everyone, I think everyone who gave one of those answers, I gave you credit for it. So the score that you received yesterday, that'll go up by one point. Okay, so that'll be reflected in your corrected grade. All right, but like I said, that question should have been, instead of loan to value ratio, LTV, or whatever it said, it should actually read loan to asset value ratio. The LAR expresses both A and B. Excuse me, the LPV and the LPC. Okay, and that comes directly from the book. All right. Any questions? Any questions on that?
No.
No questions on that. Okay. So
I not really a question, but if I remember, this question was on another homework assignment we had too, right?
I'm not sure. It might
Yeah,
have been.
it was.
Yeah, I think so, because I think I remember referring to the old homework, because I think in my first homework assignment I put the E, A and B, but I got that wrong. So this
Okay.
time I went ahead and put A.
Okay. Well, what to do is send me an email, and I will make the correction on that. I will give the credit on that as well. For some reason, this one's slipped me.
Okay.
Okay, and some of the questions were supposed to be reworded and corrected, and unfortunately, this is one of those that slips through the crack. So send me an email, and if anyone else is affected likewise, I will make the correction on the homework grade. Okay. All right. Okay, every point counts. Every point counts.
Sure does.
Okay, so question number 3 again, section 2, question number 3. Again, going about judgments, read the updated information, which is also discussed in class. So you have the PowerPoint presentation, and you have those corrected, updated pages for the section in the booklet. I think one of the students said that she was missing that section in her book. So what I did was I just updated the pages again, with the exception of the VAT, the section on VAT, and then I sent it out to everybody one time. Okay, so everyone have the corrected version of that section of the booklet, the manual. Okay, so which of the following is true about judgments? None of the above would be D, because the first one says they expire in 10 years from date of last payment. They do not expire. They expire 3 years from the date of last payment. None of those apply.
They used to expire though, right?
They before they did not expire.
Yeah, that's what
They
I
were
meant.
everlasting.
They never
Right.
used to expire before. Okay.
Right, but several years ago, I think 2016, 2017, they've changed the laws so that so mortgages, judgments expire on mortgages now 6 years.
6 years, yeah. I
Yeah.
think I remember reading that.
Okay, so so they expire 6 years. Okay. Now section 3, I think there may be two questions on 3. I'll just mention this. Everyone got question 1 correct, but just make sure you get your spellings correct. So promissory is P-R-O-M, like prom, going to the prom. And issory is for 2 S's and it's O-R-Y. So prom, I-S-S-O-R-Y, promissory note. Okay. And again, if you're not sure of the spelling, chances are, if you look at another section, there may be a question that talks about promissory note, and you just look at it, see what the spelling is in the other section. Okay, so that is one of the tips that I would have given later on, but I've given that to you just now. Okay, so question 1, then I think question 6. Okay, and with question 6, all I would say is yes. So it's there are basically 2 types of borrowers. One is cannot pay, and the other is will not pay. Okay, so cannot pay and will not pay. Okay, so just to make sure that make that clear. Okay.
Mr. Nottage,
Yes,
what
ma'am.
was the answer for number 2
Number 2
or the question for
of
number
section
2?
3.
Yeah, of section 3.
Liquid
I have the
assets.
answers in front of me.
Liquid assets, such as cash.
Ah, okay. I know it was
Liquid
something
assets,
else.
not fixed assets. Remember, we corrected that in class. I think it was saying fixed assets, and we corrected in class, and you've gotten the presentation again. You've gotten the notes. That section of the manual updated. Okay, so liquid assets. Okay. Okay. Let's see. I think that does it for homework number 6. Okay, so let's look at the mock final exam. Okay, let's go over those answers. Mock final exam.
That's the last one you sent us, right? That you told us to attempt.
Yes. Okay.
Mr. Nottage, this I tried to do this without the book.
That's fine.
Good luck.
This
Good
is
luck.
rough.
Good luck. Good luck.
This was a little rough. I ain't even gonna lie.
Sorry, you're fading in and out. I didn't get that.
I said this was rough. Like I tried to do it without the book just to see, but this was rough, especially section 2.
Yeah, section 2, I didn't do at all.
Okay, well, that's why I said try it first without the book, and then try comparing the answers to your book. But what you will find is the answers you get wrong, you don't get them wrong. You don't get them wrong again if they come up again in some form, or shape, or form in the exam.
Right.
Okay.
There's one thing about getting something wrong that sticks in your mind, and so when you see that again, what do you call it? Once bitten, twice shy. Well, okay, so I'm glad that you attempted it without looking in the book. Okay, so let's go through the answers. Okay, and if I'm going to pretty much go through them, but if you need me to stop to discuss any of the answers, you can stop me. Okay, so section 1, question 1 is true.
Okay, I
Question
get that.
2, question 2 is false. Question 3 is true. Question 4 is true.
Okay.
Question 5 is false. And I'm looking at these and seeing that some of these came up in the homework.
Yeah.
Yeah. So question 4 is true. Question 5 is false. Question 6 is true. Question 7 is false. Question 8 is true. Question 9 is true. And question 10 is false.
Oh, I get all that right.
Okay, so let's move on to section 2, multiple choice. Question 1 is D as in dog.
Got that.
I got that too.
2 is B as in boy.
I got
Got
that.
that.
Okay, so ability means that the client will pay. No, it means that ability means that the client can pay. Yes.
Yeah.
Okay, so 2 is B, which is not true. 3, question 3 is, hold on, I scrolled up too fast.
Is it C?
Okay, so
I have C too.
which one am I? I'm on again now. I'm on 4.
Number 3.
3.
It gotta be
Three.
C. It
Yeah,
gotta
okay.
be C.
3 is C as in cat. Yes.
Yeah.
Won't or can't pay. Okay. 4 is D as in dog.
I got
5 is D as well as in dog.
Oh, I get that as well.
Question, you got a question on that?
No, I was just saying I got it right.
Oh, okay, great stuff. Okay, 6 is A and B only. That's E.
Okay, yeah.
E as an elephant.
Yeah, I got that.
7 is B as in boy. 8 is D as in dog.
Really?
Yes.
Because
Yes.
okay, I put none of the above. Reason being, wasn't it a little bit more when they explained like when it's applied by the lender to reduce risk? Like it wasn't it more to that than just that last phrase?
Okay, I'm looking through the book to see if I can find the actual And actual reference. Where is it now?
Let me go in my book. Conditions.
Yes, okay, so if you look at page 37,
Mhm.
conditions, section B, conditions B, special or additional conditions may be applied by a lender to reduce the risk.
Mm,
Okay. So that's page
Right.
37, conditions B.
Special or
Okay.
additional conditions may be applied to the lender.
Okay.
Okay.
9 is C
Mhm.
as in cat. 10 is B as in boy.
Mhm.
Excuse me, sir, you say 10 is B?
Let me go back to that. I hope that's not one of them other ones that wasn't corrected.
Yeah, 10 is B because it,
Yes,
it
10 is B, yes.
expires in 6 years.
It expires for 6 years, yes. From the date of the judgment being granted, yes. Okay, so which of the following is true about judgments? They expire, judgments expire with 6 years from the date of being granted. Okay. 11 is B as in boy.
Mhm.
14 is A. 15 is B as in boy.
Mhm.
Again, that one should not have been in there. That should not have been in there. Yeah, what I did was I just kind of scanned an old one and guys, but I thought I had eliminated all the stuff. But anyway, you won't get that kind of question. The final exam has been set, and so I've gone through the questions twice.
Okay.
So you won't have these kind of errors.
Sorry, Mr. Nottage. Can you go over 11? What? They say
11,
11 and 14, but I think the
11.
numbering is wrong. Yeah. The
Okay,
following are all true except
true
Trish
except,
had.
yes. Okay, so Trish has 85,000 in assets and 25,000 in liabilities, right? So her net worth is positive. When you take 25 from 85, you get 60,000, which is positive. Okay, so when you look at B,
That's
Trevor has 28 in assets and 37 in liabilities. So he has more liabilities than assets. So his
Right.
net worth is negative, it is not
Is
positive.
negative.
Okay, so you have to look at, again, this is one of those tips. All of the following are true except, okay, so
Okay.
look for words like not and except and other than and those kind of things, okay?
Okay. I have B, but I don't know why I put B, but it's right. Okay.
Okay. But it's good to know why you have B. It's good to know.
Now I know why I have B, but when I
Yes,
answered it, I
yes.
had no idea why I have B.
And that's the whole point of this course. So, see, I don't want us to get into the habit of, okay, I memorized this, and that is why, for the most part, I give you the formula, and I give you the stuff that you have working on your jobs, with the exception of the debt service ratio formula, right? Because you have those things on your job. I want to see what are your thought processes? How do you process? You know, and that is why, for example, on the spreadsheet, the TBSR spreadsheet, how do we go from weekly or monthly or yearly or quarterly to get the monthlies? You see, so it's the process. Once you
Okay.
understand the process, you know, you don't have to remember 1 + 1 is 2. Okay, once you understand that when I add something to something, it gives me, it should give me a number equal to or greater. So 1 +
Right.
0 will give me 1. So it'll either give me 1 or something greater. 1 + 1 gives me 2. So it gives me something greater than what I'm adding. Okay, so when you're adding, you always get something equal to or greater. Okay, if you're subtracting, you get something equal to or less. So it is the process, the thought process behind everything. Okay, the reasoning. Okay, and that is where the skill side comes in, and you know, the skill side comes in. So sharpening the skills, because the science part of it is what you were provided with at work. So you combine the formulae and whatever it is, equations that you were given at work, with your skill, makes you a better worker, and in this case, a better lender. Okay, so it's good to know why. So good question. Now you said there was another question that you wanted me to go over.
I'm assuming that this is 12, but on here it says 14.
Oh, okay.
Which of the following statements are incorrect?
Yes, okay. So which of the following statements is or are correct? Okay, mortgage loans always carry a higher interest rate than consumer loans. Okay, they always carry a lower interest rate than consumer
Right.
loans. So
Okay.
that is why that is incorrect.
Okay.
Okay, and then the others are correct. The other statements are
Okay.
correct.
All right. Didn't
Okay.
read over that properly.
Okay, and that's another thing. The numbering on this one. Wow, I'll have to correct that going forward. Okay,
Number 15 with the stamp tax would have been B.
yeah, 15. You won't you won't have that type of question in the exam.
I know, but just for information sake.
Okay.
It's B, or
Yeah, I
It
think
is
it's
B.
better.
Yes. It is B. Yes.
okay.
Yes, it is B.
All right.
Okay. Okay. So 16 is A.
54%. Got that.
Okay.
Mhm.
17 is C, as in cat.
Got that.
Oh, I got that.
Okay.
Yeah.
Yeah, so that ends that. Okay, so we move on to section 3. Okay. Fill in the blank. So 1 is either corporation or limited company. 2 is asset. 3 is the client's pool of assets less their liabilities.
So we have to put the client's pool of assets, or we could say the total the total
assets
less their
less their
total
liabilities.
liabilities.
That's
Okay.
fine. That's fine. Okay. Alrighty. That's better English. Granted, a lot of this stuff is a carryover from the old English books. Okay. So list 2 features or benefits of mortgages. So any 2 of longer repayment terms, lower interest rate, or accumulate equity over time. Any 2 of those.
You missed number 4.
I missed number 4. Oh, sorry.
Yeah, a blank is required.
A borrowing resolution is required. Okay. 6 is demographics. 7 is the decision. 8, liquid assets or cash. Using the credit series methods, the 3 key factors consider: character, capacity, collateral. Okay. When account falls into delinquency, okay, determine whether the source of problem is internal, the bank's fault, or external, the customer's fault. Okay. So what are basically two types of borrowers? One is the cannot pay, and the other is the will not pay. Again, we're saying some repeat questions from homework. Okay. Then we move on to section 4, the case study. And this one is the Balfours, I think it is. Okay.
Yeah.
Hezekiah and Lottie Balfour. Okay. So let me get back there. Get up to speed. Okay. So first thing we're going to do is complete their network statement. This is homework number 4. I had said it as class assignment number 4, then I said, no, don't do it, because then I realized that it was already done for homework number 4, but it is also appearing now in this mock final exam. Okay, so okay, so so if you refer to your readout there, you'll see we have the narrative that gives us information on the Balfours. We have the loan printout for the car loan, the consumer loan. We have a printout for their mortgage. So let's do the network statement. Okay. Okay. So what is the first? What is the first item? Let's start with cash. Is there any cash?
Yes, sir.
Okay, so we said among the assets are $500 in savings with RBC and $2,100 in savings with Biff's Bank, $937 on checking account also with Biff's Bank. So we add the 3 of those together.
3,537.
3,537. Very good. Okay. What other asset is there? Is there
Stocks and bonds.
they own some stocks and bonds? Okay. So they also own $2,700 in BIS6 listed APD Arawakpo Development Company Limited shares. So we put them in there. Okay. Okay. Do they have any accounts receivable? I don't think so.
No.
What about cash surrender value of any life insurances?
Yeah.
19,763.
Okay, so they have a joint life policy, face value 335,000, and cash surrender value of 19,763. So we put that in there. They have a mortgage, and so we know they have a real estate. So what is that amount? The real estate value?
644,500.
644,500. Yes. Okay, that's the current value. Okay. Okay. Any auto or automobiles?
Yeah, I think they say their auto total to 47,000.
Okay. So they have a car loan at RBC over one of the vehicles. The loan is being paid over the counter. That means not by salary deduction. Collectively, the cars are with 47,000 and are both comprehensively insured. Okay, so we put that amount in there, 47,000. Are there any other assets?
Yeah, they have
Sure.
furniture and art.
Furniture and art. Okay, so total furnishings are currently valued and insured at 52,000. So we put the 52,000 in there. As you said, they have an art collection with 37,500. So we put that in there as well. Okay. Are there any other assets?
No, that was all. Well, that was all I saw.
Okay, that's all that we're aware of. Yes, you're correct. So that comes to $807,000 flat. Okay, so now we turn our sights on the net worth. Sorry, the liability side of the net worth statement. And so they're not paying rent. Do they have credit cards?
Mhm.
Yes, they have credit cards. In fact, they have two credit cards. One with a nil balance and one with an $850 balance. So we add those two together, it comes to $850. We put that in. As we noted before, they have a consumer loan. What is the balance on that consumer loan?
$8,200.
8,258.
8,258, yes. And the mortgage, what is the outstanding balance on the mortgage?
142,903.
142,903, very good, okay, good stuff. Are there any other liabilities that we are aware of?
No, sir.
Okay, so we add those three items together. We get $152,011. We put that over into the column that says less total liabilities under the total assets. We subtract 152 from the 807, and we get a pretty healthy net worth of $654,989. Is that a positive net worth or negative net worth?
Positive.
Positive, okay. So that's positive. All right, so let's look at the TDSR. Okay, so Hezekiah has a salary of $750 a week. What amount goes in the monthly, the percentage used, and the adjusted amount?
3,250, sir.
3,250. We use 100% of that, so it goes straight across to 3,250. What about the bonus? How do we deal with the bonus?
Monthly amount would be 500.
Sorry,
The monthly would be 500.
500. How much of that do we use?
50%.
50%. So
That'll be 250 adjusted.
250. Yes, very good, excellent. Now Lottie, she has salaried income of $5,200 a month. How do we deal with that?
Carry it over, sir.
Yeah.
Okay, so 52 per month. How much of that do we use?
100%, sir. Salary.
Okay, so the adjusted amount would be the same. Okay, 5,200. Very good. What about the rent from the efficiency apartment?
Monthly amount would be 500, and adjusted balance would be 250, sir.
Okay, so we use 50% of it. Yes, okay. And so then we add those four items together, and we get $8,950. Okay, $8,950. Okay, so now we move to the expenses. So the mortgage, how do we treat the mortgage?
Carry that straight over, seeing that it's already in a month before.
Okay, it's already in monthly, so we put it in both columns, monthly and adjusted, correct? To propose further charge?
The same as the amount prior. The full amount of 348 would carry over as well.
Yes, okay, 348 in both columns, okay. The car loan,
And as such as well, 725 would go into both columns as well, adjusted and monthly amount.
okay, very good, okay. How do we deal with the credit cards? The first one?
Credit card, we would get 5% of the limit, which is $250, sir.
Okay, and how do we know to use 5%?
At the bottom.
We got the cheat sheet to the bottom.
Okay, excellent, okay, great. Okay, just want to make sure that you're keeping your eyes on that, okay?
Mhm.
So, okay, so that's 250 in both columns. What about the one, the Royal Bank?
One for Royal Bank, that would be $100, sir. That would be 5% of the 2,000.
Okay, so 100 in both columns. So then we add those five items together and we get 2,563. calculate the TDSR. What do you get?
I got 28.63%, sir, on this particular scenario, 28.7%.
Okay, 28.6.
Mm-hmm. I put 28.64. Same, I
Okay,
guess, same difference.
28.64 or 28.6 because you don't round up because 4 is less than 5.
Mm-hmm.
Okay, so 28.64 or 28.6, or you can round up because that 6 is greater than 5, you can round it up to 29. Okay, so 28.64 or 28.6 or 29%. If you're unsure of rounding up the whole number, keep it with your decimal points. Okay. All right, so let's look at LPV. There's our equation, LPV. Okay, so what is our loan amount, our numerator? And where do we find that?
$142,903.
Mm-hmm.
Okay, 142,903. Okay, and we get that from the mortgage statement. That's the current loan amount. Okay, so that's our numerator. What about our denominator?
Divided by 644,500
Okay,
would
and
give
again,
us
okay,
22%.
so we get that from our mortgage statement again at bottom right.
Mm-hmm.
Okay,
Right.
so we divide 142,903 by 644,500, multiply by 100, and that will give us
22%.
22.17 or
Mm-hmm.
22.2 or 22%. Okay. Okay. So finish that. Let's look at equity. What is our current value?
644,500.
Okay. So again, we find that from the mortgage statement. Okay.
Mm-hmm.
So 644,500. Okay. What is the encumbrance that we are aware of?
142,903.
Yes, and we get that from the top right, I mean top left of the mortgage statement. So 644,500 is our current value. The encumbrance that we are aware of is the mortgage, 142,903. We subtract them and we get equity of 501,597, which is quite a bit of equity. So you can see where
That's a lot.
most of their net worth, most of their net worth is in real estate. When you look back at the net worth statement, you see that a good chunk of their net worth is in their real estate. Okay. And again, you get those two figures from, in this instance, from the mortgage statement, also in your net worth. So you see their net worth is 654,000, almost 655. And of that, their net worth, I mean their equity is $500,000. So that's quite a chunk of their net worth and their assets. Okay. Alrighty. So the question is, would you lend to these people?
Mm-hmm.
Yes, sir.
Okay.
Definitely.
Yes.
You
Definitely lend to them.
Everybody want to lend to the Balfours. Okay. Okay. So so with the Balfours, would be talked about is in terms of character, capacity, collateral, or whether you use character, ability, or insurance. We told that the Balfours pay the debts very well because you can see that from their bank statements,
Mm-hmm.
the loan statements, the credit, consumer loan as well as the mortgage. plus I think we're told that the loan is paid over the counter. So it means that's not by salary reduction. So that anyone who's paying their loan over the counter, not by salary reduction, and doesn't have any late payments, they, I targeted them for loan or additional loans. So the Balfours pay the debts very well. This is evidence of good character, which is essential when considering or granting a loan. In terms of ability, again, I think they are pretty much like the Browns, because I think the Browns were around 30,000. I mean, 30% in that total debt service ratio. So the Balfours, their total debt service is 29% rounded. They therefore have the capacity or the ability to comfortably meet the payments and take on additional debt. And then insurance or collateral, they have very healthy equity in that they only owe 142,000, while that's still a lot of money. 142,000, almost 143,000 is a lot of money. But when you compare it to the value of the property, which is currently almost $650,000, that is like 20-some%, right? So additionally, is located in a subdivision where residences are valued in excess of $1 million. So they're not at the high end of the range. They are probably somewhere in the middle there. So there are properties that are within the millions. So getting this property sold shouldn't be a problem. Shouldn't be a problem for the bank in the event that they need to rely on security. Which, unless the Balfours run on some hard times, one of them lose a job or get sick and can't work, or something else goes wrong, you shouldn't have a difficulty with them. Their loan should go towards, should expire as normal without any incident, as scheduled. So they have it, character ability insurance or character capacity collateral is just which method you choose to use. You will come up with the same, you'll come up with the same results. Okay. All right. So, are there any questions on that? In the time remaining, I just want to do one or two questions and then do some tips. Any questions on anything we've covered so far for tonight?
No, but Mr. Nottage, I think it was homework 5 or 4 something, I can't remember. Where we had to find the percentage of oh Lord. I'm trying to, okay, yes. The facility amount and the interest rate and all of that, would that be on the exam? Or similar to that would be on the exam?
Are you talking about that that's on the screen now?
Yes.
Okay, great question, because that's the first thing I want to touch on next. So you've been spying on my notes. Okay, so let's look at that. So product pricing, income assessment on a borrowing customer. So the example given here is that there's a facility amount of $1.95 million. The interest rate is 10.25. We are being asked to tell what the gross interest is. We are told what the cost of funds rate is. The cost of funds rate is 4.75. So, we're being asked to give the funding costs, and we're also being asked to give the annual net revenue and also the margin or the spread. Okay, figure. And then finally, the total annualized projections, the total annual net revenue maybe add annual net interest, any fees, and I guess is our total. So let's look at the first one. So how do we work out gross interest?
Um, 10.25 of the 1.95 million would
Okay.
be 199,875.
Yes, okay, 199,875. Everyone sees that? So 1.95 million times 10.25 gives us 199,875. Okay, the cost of rate, sorry, the cost of funds rate is 4.75. So what is our funding costs? How do we work that out?
4.75 of the 1.95 million, which would be
Yes, okay,
92,625.
very good, excellent, okay, great. Everyone sees how we got that?
Yeah.
Okay, now your annual revenue, net revenue, how do you get that figure?
Minus the funding costs from the
So you
gross
subtract your
interest.
funding costs from the gross interest, okay, everyone sees that? Or you can say gross interest minus the cost of funds, okay? And that will give us 107,250. Okay, so it's a matter of subtraction, okay, a mathematical computation. And our margin or spread, how do we get that?
Minus the cost of funds rate from the interest rate.
Okay, so we subtract the 4.75, the cost of funds rate, from the interest rate, and that gives us 5.5.
550.
Okay, so if you want to check, that the annual net revenue amount is correct, you do 5.5% of 1.95 million, and you should get 107,250. So that's one way of double checking.
Okay.
Okay, all right. So now looking at the annual net revenue column going down to the bottom, what is our total annualized projections for this customer?
$126,750.
Okay, and how did you get that? How did you arrive at that?
Add the 107,250 plus the 19,500.
Right, okay, so you add the 107,250 to the 19,500, you get 126,750. Excellent. Okay, so everyone understands that?
Yes, sir.
Okay. All right, so let's look at another one. Another type question. It's one of those charts. So we got to fill in these ones with the yellow. So column one, compare. So row number one, compare. What goes in that section?
Character.
Character. Okay. Two credit Cs. What goes in that column?
Capacity.
Capacity.
Okay, capacity or capability. Okay, great. Three, main thought.
Won't or can't pay.
Can't
Oh.
pay.
Mhm.
Won't pay or can't pay. Okay. And two, column four, explanation for number two.
Has the
They have
financial
the,
resources to pay.
Yes.
yeah, I was gonna say have the
Okay. Has the
ability. to
financial
pay.
resources to pay. Yes. Okay. Okay, great stuff. All right, let's look at another chart. Alrighty, so we have, if a person has good character, good capacity, good collateral, we say yes, we lend them the money. If they have good collateral, good capacity, but don't have any collateral, sorry, good character, good capacity, but no collateral, we said yes. Character plus collateral, we say maybe, sometimes no. 4, they have good capacity, good collateral, but no character. Do we lend to this person?
Run them out the bank.
No.
Run them out the bank?
Run them out the bank.
No, okay, exactly. You don't want to see them, but you be nice and running them out the bank. So no, okay. Alrighty, so let's look at a final chart. Okay. Okay, so this is the letter of credit or documentary credit. We have the importer does trade with B.
Exporter.
Exporter.
B is exporter, okay.
Mhm.
And then A is
Letter of credit or funds being funneled to them.
okay. Turn to page 97. So what does it say on page 97? What should
Payment.
A be?
Payment.
Payment, yes. Okay, so A should be payment. Okay, so the importer goes to his bank, sets up the letter of credit, and the pay that is to effect a payment. Excuse me. That is to effect the payment to the exporter's bank. So A is payment, B is exporter. Okay. Let's move to some exam tips as we begin to wrap up here. So again, read all questions carefully. A lot of the questions that come up may be familiar to you, because some of them may have been in the homework assignment or class assignment or end of chapter review. But read them carefully. Don't allow familiarity to cause you to throw caution to the wind. Okay, so read all questions carefully. Again, all these questions come from a pool of questions. Some of the questions in true or false may appear that you may be used to, may now appear in as a multiple choice or fill in the blank. So it's based on the content. It is limited to what you could test on. So a lot of the questions may be familiar to you. Okay, so read them all carefully. As I said earlier, look out for words such as not and except or other than. Okay. Look out for keywords or phrases. Okay. Like we talked earlier about, if it's talking about a ratio, that is a percentage. It's not a dollar value. So look out for those in your questions. Like I think there was one that LTV or something is the dollar value, whatever it is. Also look to see what it is saying. So it may be a percentage, but it may not be. So for example, it may say but I can't think of one right now. But just be careful and look for some of the words or phrases. Okay, I'll go through one or two in a minute. If you have difficulty with a question, move on to another and then come back. Make some notation. If you have a pencil nearby, just put a little stroke or something or to remind you to come back to that question. But in any event, once you feel that you've completed your paper, it would be best to still go through each page and see that you have answered each question. Okay. Sometimes if you have difficulty with a question, it may be because of exam anxiety. And when you go to another section, after you come out of true and false, you may go on multiple choice, or you want to fill in the blanks. It's one of those questions that may trigger something in your mind, and you say, "Oh, that's the answer." Then you go back. Okay. So sometimes another section may help you with another section. And again, make sure you answer all questions, fill in all blanks, particularly those TDSR spreadsheets. Don't leave out where there's 100% or 10%. I mean 50%, because each one of those are worth like half point. You don't want to throw away points, and every point or half point counts. Okay. So, for example, we have here a mortgage loan is an example of a lending facility that does not have a disciplined repayment plan. Okay. Versus a mortgage loan is an example of a lending facility that has a disciplined repayment plan. So look out for words like I said earlier, such as not, okay, or accept. Okay, they will not be underlined or bold in the question, so you have to look out for them. Okay, and this is one that I was talking about. The loan to value ratio expresses the dollar value amount that you own in a piece of real estate. That is false. Okay, actually it is equity that expresses the dollar value amount that you own in a piece of real estate. Okay, so again, watch out for the wording. Don't allow your familiarity to cause you to drop your guard. Okay, again, loan to value ratio, LTV, LPV, loan to cost, LTC, LPC, loan to asset ratio. This is that question that I had to correct earlier from the homework. It is either LAR is either the loan as a percentage of value or the loan as a percentage of cost. Okay, so LAR covers LPC and LPV. Okay. Another thing to watch out for: do not confuse PAT, the loan application, that is for the request, with PACT, pricing or interest rates. And just for clarification, when we look at PAT, the client's request is demographics, financial information under request. So it's PAT. So you're looking at purpose, amount, and term, whereas PACT, which PAT is a loan application, PACT is interest rates, how you assess interest rates or determine interest rates, and that's purpose of the credit facility, age of the client or business, collateral offered, and the term of the facility. So don't confuse those two acronyms. Okay. If there are no other questions, that's it for the review. Are there any other questions or areas you need clarification on or have questions on?
Mr. Nordage, can we go back to the what is it called? When we were trying to find the gross interest cost of funds, I just wanted to see how do we get the costing funds?
Okay.
Or the funding costs again, please.
Okay. All right. So facility amount is 1.95 million. We're given the interest rate of 10.25. Okay, and remember I said in an example like this, you would have to have at least two. There'll have to be two knowns. Okay, so this could have been an example where we were not given the cost of funds rate, but we might have been given the margin spread rate. We can still determine the cost of funds rate by simply subtracting the spread from the interest rate, which will give us our cost of funds, because it's an arithmetic equation. Okay, so in this instance, we're given the interest rate and we're given the cost of funds rate. Okay, so what we do in this instance, in order to get the gross interest, we get 10.25% of 1.95. Okay, so 10.25% of 1.95 million is 199,875. You with me so far?
Yes, sir. I got that part.
Okay. Now the cost of funds rate is 4.75. Okay, and the cost of funds of what it is costing us to borrow from another financial institution or whatever it is, where are we getting this 1.95? It's costing us 4.75%. Okay, so you say 4.75% of 1.95 million, and that gives us 92,625. So you got that?
Yes, sir. So the cost of fund rate actually goes back to the facility amount.
Sorry, the cost of funds.
Okay, we would get the 4.75% from the 1.95 million, right?
Yes, so 4.5% of 1.95 million gives us 92,625.
Thank you, sir.
Okay, so then when we look at our annual net revenue, you would be looking at a dollar figure. So we subtract 92,625, our cost of our funding costs, from our gross interest of 199,875, and that gives us 107,250. You see that?
Yes, sir. We minus from the gross interest and the funding costs to get our actual net revenue.
Right. Okay. And then our margin or spread, our margin or spread is the difference between the cost of funds and the interest rate that you actually charge. So our cost of funds is 475. We subtract that from 10.25, and that gives us 5.5. And if you want to double check it, you add 5.5 plus 4.75 should give you 10.25.
Thank you so much, sir.
Okay. And then if you want to check the annualized net revenue, because remember we simply subtracted the 92 from the 199 to get that 107. If you want to make sure, you want to double check that figure, you do 5.5% of 1.95 million, and you'll get 10725. So there's a way of double checking. Okay.
Thank you again, sir.
And then finally, what we get from this customer, we make interest from this customer, and we get some fees from this customer. So we get 107,250 net interest from this customer, plus 19,500 in fees. So our total annualized projections for our annual net revenue is 126,750. So we just simply add those two together to get our 126,750. All right.
Thank you, sir.
Okay, great stuff. Okay. So that's the end of the review. Final exam information, once again, Thursday, September the 1st. That's next Thursday, a week from today. 6 to 8:30, 2.5 hours. Most people I found historically complete before then, but if you need to use the full time, use it full time. Those of you in New Providence, you'll be at BIF's. The student in Abaco, Mr. Pratt will set you up online to deal with that. Calculators, normally you're not allowed to use cell phones or iPads. You should be using a standalone calculator, but that's up to the discretion of the invigilators at the time. Okay, they'll make a call on that. As I said, the exam has been set. So there are actually 40 questions in a true and false, 40 questions in multiple choice. Fill in the blanks are 23 questions. And then there's a case study type question similar to Martin and Cherry Roll. That's worth 27 points. So you have 20 points for true and false, 20 points total for multiple choice, 24 points fill in the blank, 27 points for the case study. What was I going to say about that? Yeah, so I think it's a total of 91 points. So I try to keep it around between 90 to 100 points for the exam. So there's a total of 91 points for the exam. Okay. The chapters are chapters 1 to 9, 11, and 18. Okay. Questions that are not on the exam. Chapter 1, you will not have a question like review question 7. I said that from the inception. That's not the one where you have to calculate the different tiers of reserve requirements. Okay, you will not have a question like that. I have kept my promise. Okay, so there won't be a review question like question number 7. However, you should know a bit about reserve requirements, secondary, primary reserves, etc. There will be no very long answers, with the exception of when you get to the case study. So if you look at chapter 2, the review questions, number 2 and 3 in particular, those very long answers, you won't have any questions like that. Okay, and then chapter 8, there will not be a review question like number 7. Again, that has to deal with real estate sales, the VAT stuff. Okay, so I think those are the major items that I can think of that will not be on the exam. Okay. Any questions on that?
No, sir.
No, sir.
Okay. All right, so again, your key resources, key study resources would be end of chapter review questions, homework and class assignments, mock midterm exam, the mock final exam, and 3 various case studies that we did. The main one is Martin and Cherry Roll, of which the Browns and the Balfours are patterned after. Okay.
The mock was, excuse me, sir, the mock was homework assignment number 4 or 5?
The mock final exam, that would have been homework number 7, but that's ungraded.
And the mock midterm would have been homework assignment.
The mock midterm was homework assignment number 4, I think it is.
The mock midterm was in the class assignment 3.
Or was it class assignment 3? Let me look at my notes. No final exam. Hold on, let me look here. Okay. My records. Yeah, the mock midterm was homework number 3.
Okay.
The mock was homework number 3. Sorry, number 4. The mock was homework number 4.
Okay.
Okay. All right. So so if you look at all of your end of chapter review questions, homework and class assignments, your mock midterm exam, mock final exam, various case studies, and again, look at the sections of the book I sent on August the 18th, where corrections were made specifically with regard to the what do you call it? The judgments, okay? Judgments and some of the other areas that were amended. Like when we changed fixed assets to liquid assets. Okay. So pay attention to those.
I didn't hear his name.
Yeah, go ahead.
I didn't hear what you said.
I heard pay attention to that.
You didn't hear you say you didn't hear what?
I didn't hear, no, I didn't hear what you said prior to pay attention to that.
Oh, I was saying that the corrected there was a student who said that she was missing some sections, right? And so what I did was I updated the sections that needed to be updated, in particular on judgments, and I sent it to everybody. That's an email dated August the 18th.
Okay.
Okay.
And you say the judgments expire after 6 years?
Judgments expire 6 years, yes.
Okay.
Okay. Any further questions or concerns? If as you do your studies and whatnot and you get stumped, shoot me an email and I'll get back to you. Okay.
Okay. One more question, just for clarity. The loan to value ratio expresses the loan percentage for the LPV and the LPC, and the loan to asset expresses the
Are you there?
okay, so the loan to value expresses the dollar value? No, that would be the
It's a ratio, so it's a percentage.
okay. So the answers for the percentage is correct. The loan as a percentage of the value of the collateral security, LPV, and then the LPC.
Right. So it's and the bank will lend on the lower of the LPV or the LPC, or some people call it the LTV, the LTC.
Okay.
Okay. So
And then
one is value, one is cost. So
right.
usually the value is higher than the cost. So the bank will normally lend on the cost if the cost is lower. Where a person is purchasing real estate, If
Mhm.
someone's coming to you to purchase real estate, it may be valued $100,000, but it's being sold for 95,000. So then the bank will then make the lending ratio based on the 95,000, not the value of 100,000.
Okay.
And when you're considering the loan to asset ratio, right? The loan to asset ratio takes into consideration both the LPV and the LPC.
Okay.
Okay, so that's the LAR, loan to asset ratio.
Okay.
Okay. Okay, if there are no further questions, that's brings the summer session of 2022 to an end. And I wish you all the best in your exam, your final exam. Again, as you study, if you have any, get stumped on anything, shoot me an email and I'll get back to you and hopefully be able to resolve whatever the issue is that you're having being stumped on. Okay.
Okay.
All right. So with that, I bid you all a good night and all the best in your studies.
Good night, all.
Okay. Good night.
Okay, thank you so much. Good night.
You're welcome. Good night, everyone.